Okay, great. Thank you all so much for joining us for the NEISC's first session of what will be 3 sessions on the trade-offs between growth and financial regulation. First of all, some housekeeping rules. I should tell you all this event is being recorded, which means it is on the record. I'm not sure if there are other journalists in the room, but because it's being recorded, anything that you say can make it into the public record. Beyond that, we have fire escapes, follow the green signs, and that's about it for housekeeping. Also, we will be taking Q&A throughout. Just put up your hand. Please do identify yourself, and if you're with an institution, identify that as well before asking a question. With me, I have Sir John Vickers, who I'm sure doesn't need any introduction for most people in this room. I know him best from the Vickers report. If you'd like to give a little brief overview of your life and times, John, and then we'll kick off with my Q&A for you. I say brief overview of your life and times now.
So 20 minutes?
By which I mean 5 minutes, John.
So overview of my life and times. So my career has been roughly 3/4 academic, and I'm at Oxford University. I'm head of All Souls College, which in term time means I'm rather overwhelmed with that. But in the gaps, I try and do economics in various ways. And then roughly a quarter of my career has been in policy jobs, Bank of England, monetary policy, then 5 years doing competition policy, and then a fascinating 15 months doing the Independent Commission on Banking.
Okay, thank you so much. So our topic today is the trade-offs between growth and financial regulation. Is it fair to say you would be on, if you're looking for the balance between which you think is more important, growth or financial regulation, would you put yourself in the latter camp? Would you always prioritize like the safety and soundness over some more adventurous policies that would stoke growth?
So in short, this might sound a bit optimistic. I think good regulation and growth are allies, not enemies. And I get more and more disappointed how so much debate in recent years positions them as opposites. And I mentioned a moment ago that I had a phase doing competition policy. You get the same, I think, false conflict going on there, as though in some way competition is inimical to growth. But we just had the Nobel Prize given to Philippe Aghion and others for work which shows that they absolutely go hand in hand. Now, bad regulation can be inimical to growth. So I think the question is about how to do good regulation, not simple regulation versus growth. On safety and soundness, my view in short is that the best that prudential regulation can do for growth is to maintain safety and soundness. And if you want a sort of vivid example of why that might be true, the events of 2007 to 9 and their prolonged aftermath, economic, social, arguably political events too, I think that shows you why regulation that was way too casual about safety and soundness pre-07 can be terrible for growth. So I think they go together if done right.
So when you talk about this, the way you frame it is very similar to those of us who will have listened to Andrew Bailey talk about the same topic, to Sam Woods as well. But even though they always say, we should never sacrifice regulation, or we should never sacrifice safety and soundness for growth, and we've looked to balance both. From our previous conversations, it sounds like you think they haven't really got that mix right in what they've actually done. If we look at what they say, it sounds very similar to you, but what they've done, you don't entirely agree with, I think.
So as far as I could tell, I think philosophically, we're all in the same place. Again, I wouldn't quite use the language of, do you prioritize growth over safety and soundness? I mean, if you've got periodic, big crashes in the system that have these scarring effects and growth effects, then you're not doing any good for growth, properly conceived, if you neglect safety and soundness. Now, on the precise policy settings, as some people here will know, I mean, so happens today, David and I put a column in Vox EU, which is critical, or at very least questioning, about the Financial Policy Committee's December announcement that it was going to ease capital regulation for banks. And we could explore what some of those underlying differences of view might be. Just to mention one of them, I think if one has absolute faith in resolution working. So that is, you think you can resolve failing banks without wider systemic effects. If you have absolute faith in that, then you can safely ease equity capital requirements on banks. If you do not, then I think it's an unwise move. And our view, right or wrong, is that you cannot have total faith in that. And therefore you need, you should not be, if you're going to change current policy, which has basically been in place for 10 years, our view would be, if anything, you should be tightening, not easing.
So the headline, for those of you who didn't follow the ins and outs of the FPC's banking capital review, the headline is that they lowered the benchmark capital rate from 14% tier one of risk-weighted assets to 13%. Now, when I talk to banks, they're somewhat underwhelmed by that because the benchmark capital rate doesn't translate into actual capital requirements. It doesn't affect their stack in a literal way. So no offense to anyone from the Bank of England here, but they see it as doing something, as kind of seeming to do something while actually doing very little. But you're still concerned about it.
Yes. I mean, and also, if I'm not putting words in the bank's mouth, but if they're actually not changing things substantially, but they're presenting it like it's a change, that's a pretty curious place for an independent central bank to get itself to in its public relations. So if it really isn't much of a change, I think they ought to be saying it really isn't much of a change rather than portraying it.
But there is a backdrop, both like domestically and internationally,
Absolutely.
where, as I'm sure everyone in this room has followed, there has been a lot of pressure when we have the secondary objective around competitiveness and growth. I know you're not a fan of that,
yeah,
but it is something which the Bank of England must live with and must. You mean there is these letters that go back and forth from the Chancellor to the Bank of England to the FCA about how are you discharging your various obligations. So do they not have to kind of appear to play nice on that?
Well, I mean, that may be the politics, but it's depressing if we've reached that point. I mean, Eddie George was the governor when I was at the bank. Can't imagine him playing nice for political purposes in that sort of way. I think he'd have told it like it is.
So do you think Andrew Bailey should tell it like it is a bit more then?
Yeah, and I think on the whole he does. So I don't mean to be critical, but
because he did. I mean, it's not like the Bank of England, in fairness to them, plucked this figure out of the air. They did produce a very rigorous document explaining how they got there from a scientific perspective. And they also brought in the international comparison, and we'll talk about that in a second.
Yep.
But it's not like they just said it is currently 14 and we think we need to look good, so we'll make it 13. There was a whole rigor behind it. I think you've got a slide as well that deals with some of their outcomes.
Yeah, depending, we could get onto that if people would like. If I could make just two general points on that. They clearly have a methodology and so on behind it. However, a point that we make at the end of our piece is the contrast here between what the MPC does with monetary policy and what the FPC does with this kind of decision. And they're both tremendously important decisions. It's not that one's much more important than the other. I mean, this is a big deal. This is a multi-year capital setting. The way the committees work is totally different because there's lots of insight into what the MPC is doing. There's lots of individual accountability. When I in fact, I remember, jogged my memory the other day, 1999, I gave a talk here, National Institute, on the economic models at the Bank of England because we were publishing how the models, plural, it's one of my main points, Mervyn made me say that, were open to public scrutiny. And there isn't the equivalent scrutiny of the analytical work that behind what the FPC is doing. And I'm not criticizing them for that. It's just a fact that it's not there. So we are keen, and I would encourage other academics, the more one can lift the lid to see what this analytical machine is, how it's done, what the sensitivity analysis would be, and so on, I think would be incredibly helpful. One can make inferences, and I remember doing that from the 10 years ago paper by Martin Brooke and others, and you kind of worked out that, in my view, some very odd assumptions had gone into that model. And I think it would be really great. And I don't see resistance from the Bank of England to this, but I just don't know if there were much more availability of that scrutiny. I also think it's a shame that the committee works in such a consensual way. I know that may sound a bit odd to say that. And it's partly the statutory requirement I think says something like consensus if possible. And I suspect that was done because when the macro-prudential toolkit was introduced, there was a feeling there could be a lot of political heat on individuals on the committee if mortgage things happened in this part of the country or that part of the country. So it was to give, in a sense, a bit of anonymity cover to the committee. I think it has the downside that we don't see the cut and thrust that you see in MPC minutes, including the recent lots of MPC minutes. You've had vote going this way and that. Individuals say now, I think my own view is going too far. Each gets their own paragraph. My worry about that is that if that had been the case in my day, I'd have decided what I was going to do well before the meeting, whereas we had real meetings. I'm not saying they don't have real meetings now, but I think I think it.
Careful, Nigel.
I mean, we were arguing about everything days after the announcement. I mean, which I think was very healthy. It wasn't always enjoyable, pleasant. It is with hindsight, but at the time it wasn't. It's like jogging. It's horrible, but after you've done it, it's fine. Yeah. Another point I'd make, in the last 6 months leading up to their announcement just before Christmas, I was one of 3 external independent advisors for the review of bank capital by the Reserve Bank of New Zealand. And this is all public. There was Torsten Beck, Elena Carletti, and me. And the deal was that we would have lots of meetings with the staff and with the very highest level, both in the Reserve Bank and in the Treasury, about the issues, and that we would each write an individual report at the end with our views, and they would publish that. And I thought that was a fantastically good process. I didn't entirely agree with the way they came out, but I thought in procedural terms, that was very impressive. And their consultation documents had different options, sensitivity analysis, including some quite detailed stuff. I like for the techies here, if the Modigliani-Miller coefficient, instead of being 0.5, was 1 or 0, it would make this difference to the numbers. So the sort of thing I think it'd be great if we could get to in the UK, the New Zealanders up to a point were doing, and were doing publicly. I mean, there were some things that were happening, you can't do everything in public, but I thought it was admirable the way they went about that in procedural terms.
Like you said that this was very technical work, and I just wondered, would there be enough appetite? I mean, the MPC, what they do, setting monetary policy, is something, I think a lot of people think that they understand the level of interest rates. Like they would know what it is, they know up, down, and it's often the arguments are understandable to a mass market audience. Would the FPC deliberations on capital be understandable and accessible if they were? Like, is there enough of an audience besides this room for that?
But even this room is not to be, sneezed at. One thing that shocked me 10 years ago when I was critical of the bank capital policy that they announced then, and I was very much put on the naughty step, that was in a consultation process. The sum total, the number of consultation responses for that really important decision was 4. So I was 25% of the responses. And there's, something wrong there. I think another big difference between monetary policy and this kind of question is you have in the city massive number of people for whom the next interest rate decision is massively important, and the bond market is moving around basis point the whole time. So it is highly and immediately market sensitive, whereas this, what we're talking about here, isn't.
So we debate this on the FPC coverage all the time, because some of you may or may not know that for the FPC, they lock all the journalists in the dungeon, like 2 floors underground for the Bank of England. We're locked in there for an hour and a half. It's the exact same as the whole row for the MPC. We're not even allowed to go to the toilet, even accompanied for that hour and a half. Like they treat it like it is the nuclear codes. And I sometimes say, guys, this is not like that. It hardly ever moves the market. Even the day we had this thing, I think UK bank shares rose marginally, but it's not as material immediately.
Correct.
Just coming back to, so there is going to be a consultation on these Bank of England proposals.
There is, yes. And we're doing a kind of advanced response to that. But when it was announced at the beginning of December, it's to April 2nd, something like that.
Yeah.
I think it's a 4-month period. So the bank is, is open to that and good for them. But there's much less to go on and to work with analytically than I think would be good.
So do you think that we'll get more than 4 responses this time around? Would you encourage other people in this room to maybe?
Yes.
5?
Possibly double figures.
Double figures. Because the industry did have, I mean, they didn't ask for advice ahead of it, but there was a substantial, I think it was about a 30,000 word submission from UK Finance by way of advice in advance of this policy, unsolicited advice. So there was almost a pre-consultation.
Oh, I'm sure. You know, the one of the bizarre things about doing the Independent Commission on Banking was how the scale of resources that a number of the banks were investing.
I'm sure you got lots of unsolicited advice as well.
We were 5 commissioners, 13 or 14 staff members, and I think in total, I think we spent 350K plus the salaries of the people, whereas there was squillions being put into the lobbying effort. Though, you see, the politics then was very different because of in the aftermath of the crisis, the political power of the banks was weak.
And now it is.
And it's very different now. Also, after we'd reported, you had the LIBOR scandal. So when Parliament was deliberating all of that, the banks weren't in a great position to push back.
Because when you think about the politics now, I mean, it is very much in favor of having less burdens on the industry. And that's not just a factor in banking, that's a factor more broadly.
Yes.
And there is a bigger, well, arguably a bigger decision, and maybe a more important one coming around the ring fencing regime and how that will be defended or not. And we've been getting signals that there might be something reasonably significant around ring fencing. Yeah, that's kind of in the eye of the beholder as to what you regard as being significant. But how important, I mean, presumably you're still quite attached to the idea of ring fencing.
I still see its profound wisdom, if that's what you mean by attached. Yes.
And how important is it that this isn't the thing that they gave on?
Well, I think I'm certainly not saying it can't be improved. So I was not. I didn't feel at all miffed by their raising the threshold with inflation. I seem completely reasonable thing to do. I think it is now part of the financial architecture of the UK. I think it is a good thing. And if I were a bank wanting to do lots of global investment banking funded by UK retail deposits, I'd be quite irritated by the ring fence.
If you were Barclays or HSBC.
Because that's what it stops you doing. I see nothing in the declared agenda of the current government that says we want that sort of thing to happen. I thought it was investment in the UK real economy that we want. And ring fencing is very helpful for that, not the opposite. And Andrew Bailey made that point extremely clearly in his letter in the spring to the chair of the Treasury Select Committee. And I think that's a really important point. I just do not think it would help the government's agenda to make that move.
But is there a risk that when the government has said that they've indicated they are sympathetic to some of the industry arguments and they have announced another review, so that almost means they have to do something? Like if they said, we looked at it and we think it's operating well and 35 billion works, thank you very much, that's kind of underwhelming.
I mean, there may be other adjustments, but in terms of the fundamentals, I think it would be a grave mistake to undo that. I mean, the best argument against ring fencing back when Parliament legislated was the cost of doing it. But the cost of doing it is, we thought was well worth it. I continue to think that. But that cost has now been undertaken. It's a bygone. So the argument for keeping it, I think, is stronger than the argument for doing it in the first place.
So I'm going to do a show of hands in the room. Is there anyone brave enough to say that they're in favour of abolishing the ring fence? John, you can actually close your eyes for that. Okay, we got one half hand up. Anybody? Okay, a few potential. Could you maybe give us some ideas and maybe identify yourself too?
Well, yes, that would be instead of the leverage of 25, it would be leverage of 1, narrow banking. I mean, another thing would be Glass-Steagall, you know.
Yes.
And indeed, in I think in the Lords debate, there was some moves towards, there's that power, isn't it? Andrew Tyree was very keen on, where in certain contingencies, full separation rather than ring fencing could happen. I got for Christmas the Andrew Ross Sorkin book, 1929. It's really good because he managed, there's enough in the historical sources for him to do this fly on the wall thing that he does, which you'll be familiar with if you've read the Too Big to Fail book. And I learned some things about Senator Glass, which I hadn't appreciated. My goodness.
Okay, on that interesting.
I'm not going to ask about Senator Glass, American background. I'm Steve Cicchetti, and I've spent a lot of time. I have a similar background to John's of being 2/3 an academic or 3/4 and 1/4 elsewhere. I want to ask a simpler question about capital requirements in general, which I've asked also, risk officers and bankers, and that's how you would feel about just substituting a simple, albeit quite a bit higher leverage ratio and just getting rid of everything else. So we can have a debate about whether it should be. I would choose 10 or 12%, but just get rid of everything. It's all gone. I would actually, for reasons we can discuss later, get rid of liquidity requirements too, but make it simple.
So I'm very sympathetic to that, but for a reason I'll come to, it's, I think, not what I do. So a problem we have in the country with regulation in general, and not only in this sphere, is it's so unbelievably complicated and bureaucratic. So we have a lot of rubbish regulation, in my view. And what we should do is to work out what the really core things are and do them in a simple way. And it is quite astonishing how complicated bank regulation is, with all these different kinds of capital buffers. Then there's this murky Pillar 2 stuff, and there's supervisors and blah, blah, blah. And you just don't get that. You may get other things, but you don't get that in the rest of the economy. And the complexity is in part because the political and society decides we're going to sail close to the wind. So you have to have all these other protections and things. So if you could just go to, have plenty of equity, whatever, by some metric, you could do away with massive amounts of complication otherwise. Things like I thought the bankers, the bonus cap, I thought that was ridiculous. I mean, pointless, silly, you could just, get on with it. You have enough equity that you're not going to be a problem in any conceivable scenario. And there have been some voices in the US, I think partly of John Cochrane would be this view. He was proposing give the banks an off-ramp where they can have a choice. All this complicated stuff now, or the road to simplicity of the kind that you're describing.
Like the UK strong and simple regime money, that's not quite as simple, but that is a choice for the smaller banks.
Well, yes, I mean, the strong and simple, another example of why philosophically I would see myself as very much with Sam and Andrew. I mean, the implementation is another thing. So why am I not entirely of that view? So the problem we had with the Independent Commission on Banking was that we're just one small open economy. And to go it alone doing that, I think could be problematic. I'm not of the view that you have to do what everybody else is doing. I think you've got margin of discretion. And one of the reasons, not the main one reason we went for ring fencing was that it would enable you to have higher capital buffers for domestic retail banking than for global investment banking. Because if you have it for global investment banking, then you really are affecting the competitive position. And what was, for me, very disappointing about the 10 years ago Bank of England decision on capital was that Parliament had said, here's this systemic risk buffer, you can go up to 3 percentage points. And they went for absolutely nothing like that. So this tool, which we were keen on maximum use of, and Parliament had legislated for, the bank just didn't go for. And I thought that was very, very disappointing.
I think we had a gentleman who wanted to come in here and then, great audience, you, and then you.
Just a quick follow-up, both related. Isn't part of the problem that we have this very strange fixation of the industry on return on equity? And it's actually a very odd way to manage a commodity portfolio. I'm going to do a lot of detail, but there's a clear alternative of a risk-adjusted, risk-weighted return on assets. And I think we would be much less worried about that international competitiveness if banks thought about their risk-return trade-offs in a more sensible way.
Yes, a couple of comments, if I may. So I think for the banks, it if I can use the jargon, the full Modigliani-Miller probably isn't true because of the tax effects and the implicit subsidy effects. So I think the banks have an interest in minimizing the equity element of their funding. And that's why they are super keen on dividends. And we've had a lot of share buyback.
Yeah.
I mean, Barclays, I think, is 10 billion of returning cash to shareholders in between 24 and 26, something like that. Now, even at leverage 20, that's 200. You could think of that as removing 200 billion of lending capacity. But nobody ever puts it in those terms because it's not in anybody's interest to put it in those terms. So I think that would be part of the point. The other thing about return on equity, I mean, I think it, in a way, what it underlines is that the stakeholders that the decision makers in the banks are principally concerned about are the equity holders. And I think their own personal incentives are typically aligned with that. Whereas, of course, there's tons of other funding, bondholders, retail deposits, and so on. But it's this favoring that particular source of funding, which in most of the economy is fine. But I think in this sector, there are reasons why that can be problematic. I remember a great moment in the hearings with the banks during the Independent Commission on Banking. We had various public events, but we had lots of closed hearings where one representative of the bank was before us and was trying to get us to understand that equity holders had to get a 12% return on equity. It's just one of those things that has to happen. And Martin Wolf, I remember saying something like this. He said, well, wait a minute, what's the risk-free rate, do you think, at the moment? Maybe 2%. So he said, I see, so there's a spread of 10 percentage points. You must be running a hell of a risky bank. And to which there wasn't a great answer. Yes.
There have been proposals that limited liability is a problem,
You're nice.
and that there should be different classes of shares.
Yes.
Where there's a kind of share on spending and spending limited liability, or as limited. What do you think of that?
I just think these institutions are so unlimited liability, like Lloyd's name. You know, they get your house in the end. Yes, I understand the point, and going back to the 1929 book, of course, you know, if you were Pierpont Morgan or some others, that wasn't so different from the situation that you were in. And of course, the leverage, I don't know, Steve would know what it was. It probably 5 times, 20%. I mean, in the crises, of course, it's different. But I mean, in normal times, they'd be running with tons of equity relative to exposures.
Yes,
Yeah.
absolutely. They were running into leverage. Their gearing was big.
Yeah, or even National City Bank, which was the more like a contemporary bank. But then the head of that, Mitchell, or whatever he was called.
Before the last part of the 19th century, there was double liability in the U.S. rate.
Yeah.
So,
But I mean,
Okay,
you had sort of, just to finish, if I may, I think you had extremely wealthy people were often behind these institutions then. And I think they were way smaller than now.
Yeah.
So I mean,
That is quite possible. I
but
think
then
we're
you
gonna
lose the scale economies if they're there, which I think they are.
Okay.
John,
Back to the room for a question.
Mario Draghi is whispering loudly in my ear. And so far I enjoyed your talk, but I'm waiting for thunder. I'm waiting for a Draghi moment. I think Laura's initial question about the trade-off, and you were cautious in your response. You talked about good regulation. But we have a growth problem in the UK. We have a growth problem across many parts of Europe. And Draghi is saying we have too much regulation. You hinted at regulation. You talked about sailing close to the wind and tying us around with all these knots. So I would like your views of what do we do? Because what is good regulation? There's too much regulation in financial regulation,
Yes.
housing regulation. So I think I would like to hear some more stronger views, like a Draghi moment, a Thatcher
Draghi
moment.
moment.
That's what Britain needs right now. Not saying let's keep it safe and stay. Let you go on this naughty stool again. Who cares, John? You need to sort the thing out.
So I think the
Thank you.
Thank you very much. I think three fundamental things you want with economic regulation. I think you want price stability. So I'm using regulation generally. I think you want effective competition in your economy for growth, not in opposition to growth. And you don't want the financial system falling over. And I would be very firm about clear, simple, robust regulation for at least those three things. I think there is a host of other things, and I see that in my daily life. I mean, it's all there for well-intentioned reasons, but whether we're talking about HR regulation or things in financial services, I remember somebody making the excellent point shortly after the crisis. No one can say there's too little regulation if they have tried in recent years to open a bank account for a child, which I had done recently. I think our son was then 12. I thought, it's time, bit of financial literacy. Went into building society and I said, I'd like to open an account for you. And the person behind the desk, well, yes, of course, it will take you about half an hour. And I thought, it takes other people half an hour. I will get it done in 10 minutes. 40 minutes later, is he a terrorist? No. And there was just something, I mean, in university life, the amount of research administration as distinct from actual research, something's gone very badly wrong. And it's partly because of incentive structure and the way the research excellence framework is done and all the rest of it. This is extraordinary complication. We've now got, this legislation about free speech. I'm very, very committed to free speech in the university world. I don't think this legislation is helping it, but it's piling another bureaucratic reporting requirements and all the rest of it. And it's just, one thing after another. So I would, in principle, I'd favor massive clearing of the undergrowth, but keep the really important trees there. Well, yeah.
Yeah.
Exactly. Yeah.
I suppose there's potentially a useful distinction between regulation and supervision. But I note there was an article in Reuters today indicating that banking supervision is being watered down. And I would personally be less worried about relaxing capital requirements if there was an increase in supervision. And I think it's interesting to explain more what I mean by that. I think it's interesting that Andrew Bailey often name drops Hyman Minsky. And Minsky's proposal essentially, from my reading, was that the discount supervision via the discount window was the way in which the financial system is best regulated. And so there's the question of, is that shift towards pre-positioning a potentially better way of managing the issues? And you could have it, as Stephen says, a simple leverage ratio, and then you could have, a pre-positioning regime to make sure deposits are covered.
Mervyn King pre-positioning, yeah.
Just to clarify, what the PRA announced today was that various things that they were running every year were now going to be semi-annual, and it was kind of a handful of those measures, but nowhere near as sweeping as, say, in the US, where what they have done is a mass reduction in the workforce carrying out day-to-day supervision. So that's pretty much what the announcement was today.
Right. So the fact that there's so much supervision, I think, needed is partly a symptom of what we were talking about earlier, because the thing is, because it's sailing close to the wind. There's a nice sort of metaphor David Miles has used, which you have a choice. You can have a strong bridge, or you can have a weaker bridge and a lot of bridge inspectors. And the bridge inspectors, they're never going to get you as good as a strong bridge, but that, they might head off some things. I think this is also an area where in steady state, strong bridges don't cost any more than less strong bridges. There's partly what I responds to what Alistair has said. And supervision, I think it can improve things, but it's not going to give you a sure loss absorber. Because the crises that hit you are the ones you don't see coming. And you can have all these horizon scanners and it's probably going to come from some different direction. So I have students say, where's the next crisis going to come from? And I always say,
I think I've asked you that too, John.
yeah, I always say, I don't know. And that's the whole point.
Do we have any other questions? Yep, the lady in front of the gentleman with the microphone. And then the gentleman back there. Thank you.
Hi, just picking up actually what you said just now about.
Just, identify yourself and your from, please.
Francis Coppola. I'm an independent commentator. Picking up what you said now about strong bridges, surely looking back on what happened in 2007 to 2009, the aftermath, I remember at the time there was a great deal of talk about how it was all about investment banks and we needed to protect retail deposits from the iniquities of investment banks. And then in 2011, I think it was, there was the Lord's report on the failure of HBOS, which concluded that it was retail banking, ordinary lending, traditional lending done extremely badly. And suddenly the fallout we saw in the entire banking sector, including small banks and building societies, and the enormous length of time they took to repair their balance sheets afterwards, does rather suggest that investment banking wasn't really the problem. So my question is, have we gone too far in saying, avaunt ye investment banks? And have we gone too far, potentially? I'm sort of feeling my way through this, in terms of building such a strong bridge that even ordinary forms of lending are difficult to do. Or alternatively, have we not done enough to protect against excessive risk in retail banking?
Was it a point on, I don't know, your chair? I think Baroness Kramer might have a thing on
I
that.
was only going to come back in because I was on the Parliamentary Commission on Banking stuff.
Okay, if you want to
Yes.
grab the mic from your colleague and then we'll come to you down there.
Sorry, so just Susan Kramer. I was on the Parliamentary Commission on Banking stand. I'm in the Lords. That did those two reports. Yes, absolutely. The failure of HBOS was an abandonment of what you might even call just basic banking and credit principles. That's not understanding that lending long and borrowing overnight to fund it creates a liquidity risk. But the culture that drove that was the culture of the investment banking success that was so that created the sense that as a bank you needed to be able to achieve these kinds of returns, and essentially reframed risk as to something that could be managed or structured out. And certainly there was there was no sense of systemic risk at all anywhere in the picture. So one of the reasons we were so strong about ring fencing was to separate the two cultures.
Thank you. And I remember Lord Lawson being very eloquent on various occasions on exactly that. That said, I was never attracted to the narrative that said investment banking, casino, bad, risky, retail banking, lovely, sort of Hovis music, good. I think it's much more complicated than that. I think a lot of global investment banking is entirely desirable economically and socially. And a lot of retail banking is inevitably risky because a lot of it's secured on either unsecured or it's secured on property, and property prices can go down as well as up. So I think it's completely fallacious to think that domestic retail banking is in some sense always going to be very low risk, and I think what happened, is not.
I mean, as anyone who followed the Irish crisis back in the day, we had banks that were lending 110% mortgages. I had a friend who literally we had been out of college 2 years. She went home to Cork for the weekend. Cork is about 200 miles from Dublin. Came back and she had bought her first flat over the weekend. She didn't have any savings. She got a 110% mortgage to pay for the flat and to pay for the furniture of the flat. And that was just how we rolled. We didn't have many investment banks, and we had quite a sizable financial crisis just from regular lending often on property.
Or look at the S&L crisis in the US.
Yeah.
I mean, that domestic as you could
had
get.
a gentleman towards the rear. If you could just
Thank you.
tell us who you are first, if you don't mind.
Harrison Moore, Market News. Just back to this question about growth. it's developed a certain sort of political currency in the last few years, and lots of different people seem to focus on different factors dragging down UK growth. How prominent among those factors do you actually believe financial regulation is in holding UK growth back? Thanks.
I'm not in a position to give a particularly good answer to that. I do not believe that the equity capital requirements of banks are negative for growth. Another really interesting thing about the debate is everybody seems to assume that there is some trade-off here. Whereas if you...
Well, I think the title is the trade-offs between. So, David, you're also... Yeah. You might want to look at that, David.
If you look at what, both in sort of, in theory, but never mind that, the empirical evidence is not that higher equity requirements for banks go with lower growth. If anything, it goes the other way. So...
But this is the thing, because I remember the Bank of England, and it has changed sides since then, but I remember a former executive director of the Bank of England talking me through, and she was very firm on a lot of people studying, and she was like, higher equity requirements leads to higher growth. And then they came out with this. So,
yes, it's puzzling. I mean, I think there might be a steady state. There might be a steady state versus short run thing. I mean, if an economy tries to double its capital requirements within 12 months, that is going to hit lending.
But I do
because
wonder,
you can't retain the dividends and stuff in time to do that. But in steady state, it just isn't there.
but how much of it is the world we live in? So at the point, myself and that former ED were having those conversations. This was pre the second Trump White House. It was pre the European simplification drive. And I think part of the Bank of England's argument, like when they looked at the capital level, they did benchmark very forensically the UK against other markets. And it did seem important to them, because we talk about the competitiveness. It's not just that the UK retail lender isn't competing with, Chase or here, it's that they are competing for equity with the people who are investing. So they do seem to be cognizant. And there is an undeniable wave of deregulation happening. They're even calling it deregulation in the US. Actually, they're calling it modernization, but we all know it's deregulation. In Europe, they'll get there sometime. They certainly want to get there. So does the UK have to be responsive to that?
Well, again, to go back to the way we thought about it on the Independent Commission on Banking, we thought for global investment banking, you have to be responsive to that.
But for the other banking, you're still looking for the same equity investors. So like you are still competing with banks. If you think about these banks, which are all listed on the markets, they're competing, and their ROE, for better or for worse, competes with the ROE you can get by investing in Morgan Stanley, by investing in Chase, by investing in Wells Fargo. So,
well, that in a way could take us into I think a really important topic, which is price to book ratios, because we've had a lot of. I mean, we've had very strong share price performance of a lot of UK banks in the last year, up 50, 60, 70%, some of them, but often going from really low price to book ratios. Now, this whole regulatory edifice is built on the accounting numbers being the truth. And we know, certainly in crises, that just is not the case. And when you see, and it's not the case now for Barclays, but for a long multi-year period.
You really like Barclays, don't you?
Because you mentioned them. I thought I'd take your, no, you're right. 0.5, they were about, for a long period. And that I think ought to trouble people. And the Bank of England will run these stress tests and say everything's fine. But the stress test assumes that the accounting number, which is double the market estimate, is the starting point. So I tried to push the idea, you should do a parallel stress test or put it in an appendix or something where you calibrate it on the implied market value rather than the book value. How do things look then? But the then governor was massively resistant to doing that. I see now, and I count this as a small triumph, the December document, they have noted how the price to book ratios are now in much healthier territory. So this might be a good point for that innovation when they next do stress tests. They could commit themselves to doing it. It's only when the price to book is well below 1, that's when the question starts to arise. I think it would be much better if they and other financial regulators around the world did that basis in parallel. And we've had that with a lot of European banks for a long, long period.
So I think there's someone in this room who knows a lot more about this debate than I do about European banks persistently blaming the regulation on their lower price to book value relative to peers.
That may be the case.
But have we any other comments from the floor?
I'm surprised John is not responding positively to your point. Oh, sorry. So Laura, you pushed John the point that Americans are deregulating come like no tomorrow, okay? And that's why their growth is going to pick up more over the coming year. And I think so my point is that Europe and UK have this problem of over-regulation. Financial regulation is overly complex. You're acknowledging that to some extent. But I think more acknowledgement of there's too much regulation. Look at the tax code. There's been review after review after review, and nothing has been done. So I think we've got to acknowledge we have a problem of over-regulation. We need, quote unquote, the Thatcher moment of deregulating. And then if we have that mindset as a community, then we'll think about how we do it.
Thank you.
But right now, that's taking regulation more widely. I mean, I think it is, this is the point everybody makes. I think it's incredibly regrettable that the government we have now made the manifesto commitments it did, because it made the most efficient ways of raising tax revenue, if necessary, were off limits without some huge political issue. I think that's just made a bad situation worse in terms of the efficiency of the tax system. I think many aspects of energy regulation have, I think they've advanced green agendas to some extent, but in terms of the trade-off between efficiency and advancing green things, we've been way, way away from the frontier. And I think that's been piling on costs, difficulty, complexity. I talked about some of the HR issues. I mean, the incentives to employ people they've been, they're less than they used to be. All for well-intentioned reasons, but this is accumulation of things, which I think, and to Draghi, I think that the same is true in a lot of the rest of Europe on that front.
Thank you. And now on the issue of price to book.
Yes, speaking with my former European Central Bank hat, I mean, if you look at the last 10 years, 15 years, let's say the price to book of US banks have been very healthy, well north of 1, while the price to book of European banks and UK banks has been very depressed. If you look at the capital requirements, the US had done a lot of gold plating on the international regulations. So had a leverage ratio that was much higher than the one applied in the European Union. So it doesn't seem that this has been really, I mean, the argument that this has been the capital requirement, higher capital requirements are the driver of low price to book ratios, I think is factually incorrect, really. I mean, the point is that in the US, there has been a very strong upfront recapitalization of the banks that enabled the banks to lend and to restart growth in the country. In the EU, we decided that it would have been too harsh for the banks to have a sharp recapitalization. So we should have a gradual phasing in of the new capital requirements. So surprise, surprise, the banks have saved capital. They have tried to, pull the brake in terms of expansion of their credit book, which has depressed the European economy. We went into negative interest rates, which is not a place where markets give high valuations to banks. So that's my reading of the story, to be honest.
And in line with that, I think part of the low price to books in Europe has been that there are a lot of legacy zombie assets that hadn't been cleaned out, and which can linger for a very long time, and they weren't worth what the accountants, obeying, I'm sure, all the accounting standards, said they were worth.
So another thing that I'm less clear on is the interaction between financial regulation and growth in an environment where there is not unmet lending demand. So if I think back to the various Bank of England surveys, it's not clear to me that the banks are not currently meeting the lending demand in the system, both in the US, which I covered for a long time, and also in the Eurozone and here. What I've heard from the banks more is that they don't actually find they're actually like struggling to lend as much as they want. And if you look at the US banks, what they've done with a lot of the capital they were keeping for Basel Endgame is they've just paid it out in dividends because they have found lending opportunities. I think I see someone disagreeing with me in the second row there. Can we get the microphone just so that everyone can hear someone disagree with me?
I mean, I keep hearing this and from the Bank of England that small businesses in the UK only want to grow organically. They have no interest in borrowing at all. I then go out and talk to small businesses, and it couldn't be farther from the truth. They just don't trust the banking system. They were banked, they were turned down, that if they go for a bank loan, they've got to put a house on the line, that the price is incredibly high. I mean, you can sort of go down the list and you can see why they don't want to touch the banks with a barge pole. Now, the Bank of England has completely swallowed that story. And the difference in the United States is there is a huge community development financial institution sector that funds small business. It's in excess, the loan assets out today would be in excess of 300 billion. That's to small businesses. It's not captured when you look at any of the big banks. It operates as a completely different sector, often with the big banks putting money in because they're required to by the regulators. But I mean, I just think the analysis, instead of saying, why is there so little demand, and recognizing a lot of it is the fact that we're missing an appropriate level of institutions to do the lending, so we might start coming out with some answers that would help us get growth.
Not to mention all the other forms of financing in the US that in Europe we don't have.
Well, and here where we've got a challenger banks and we've got an alternate banking sector, they have tended to gravitate towards the same set of customers that banks that like to service. And that doesn't include a lot of the small business sector.
The private credit and so on, which is a very different story there than here. I mean, multiple channels. Despite what you said, I still think the margin of decision at which the banks seem to be is paying out cash to shareholders. I mean, a point we made, which I don't think delighted the thread industry, is that I think the main effect of an easing, I'm with David, is larger buybacks and dividends to shareholders.
Because the Bank of England is pretty circumspect, and the ECB was as well, about trying to tell banks to lend to certain sectors. Like, they do tend to leave those decisions. And even when they came to trying to incentivize green lending and things, people were very not in favor of a green supporting factor in the capital stack. So
quite right too.
Yeah, that is a factor. Yeah. I'm just conscious of time. Have we any more questions? The gentleman there. Yeah, and then come back to you, Steve.
I would caution not to.
I think Steve's okay without a microphone.
I would caution not to implement something like the Community Reinvestment Act in the US, which is a requirement that banks lend into small communities wherever they're taking in deposits. This is it's a huge regulatory burden, and it doesn't work. So I would be very, very, very concerned if you started to do that. Now, if you want to talk about the way that community banks work, that's a different issue. But the Community Reinvestment Act and the requirement that big banks lend into every little, it's like by zip code, by postal code.
But they don't have to do it themselves. They can fund a man who can, which is the way that the community banking sector has developed.
Okay, we do have to go with the gentleman back here.
Hi, my name is Philip. I'm a recent Yale graduate. I have two questions. One goes off the point that you made, Laura, that there seems to be a difference in the playing field between the US and UK regulatory approach, specifically in private credit. John, do you think that the US should regulate more and the UK should deregulate to kind of meet each other in the middle? And I know the UK is doing this kind of system-wide exploratory scenario. Do you think anything big is going to come out of that? And just the second question, how concerned are you that the monetary policy attacks on Federal Reserve independence would percolate into maybe financial regulation independence that the Federal Reserve enjoys?
Okay, so on the first point, I don't know enough about private credit and its regulation and transatlantic differences to give a coherent answer. Now, people say it hasn't stopped you before not knowing about something, talking about, but I think there's a limit. So apologies if I on I mean, the various attacks on the Fed, of which the Justice Department moved the other day, is only the latest, I think are incredibly disturbing. And I think the risks that they pose relate to the full range of Fed activities. It's not just a monetary policy thing, but across the piece. And I thought it was very good that the former senior, former Fed chairs and other senior officials in the US, and then central bank governors around the world, I think their support for the Fed chair was very good to see.
So just on the point around the private credit, sorry, I may have confused you earlier, but the US so the piece on deregulation is about the more traditional financial sector. We haven't really got to a stage where you could deregulate private credit, because for us, we need to start regulating it. So what they're doing in both sides of the Atlantic is trying to develop regulatory approaches to it. As you said, in the UK, part of what they've done along that is a system-wide exploratory scenario. They're now on the second one of those, which is looking at private markets. It's not, I mean, how we look at that is they're testing for vulnerabilities now, but I think we're a long way away from regulations coming, because there's not a ton of appetite for new regulation. So I think that the approach is more that we're going to shine a light on where the vulnerabilities are, and we're going to hope that the market takes care of those rather than having to regulate. And I think that's been the approach in the Financial Stability Board globally as well. They're doing a massive data exercise. In the US, I mean, I don't know. Back when the UK was doing their first SWES, I was talking to the then head of the SEC, Gary Gensler, about it, and he told me they had already done their version of the SWES, and this was not a global first. I could find no record of that anywhere. So the US is doing some things. We're not quite sure what they're doing. They keep some of it internal. Certainly the UK has been more public, but we're all at the stage still of probing for vulnerabilities. The only actual regulation type stuff or supervision is when they try to use banks as a back channel into it. So what they will try and look at is banks lending to these things. And they do that through the prime brokerage and through different things. And then you can try to proxy regulate through the banks, which the banks hate, where they will try to risk manage hedge funds and private equity through the banks. John, have some thoughts on that, do you? As you think banks to proxy regulate?
Well, yeah, I was just wanting to echo the point you touched on. So many shocks and risks hitting outside the banks 18 years ago found themselves back into the banks. Yeah. And again, this is one of the whole points of ring fencing, is to try and put some fire breaks between those kinds of risks finding their way back. And the fundamental point is, if some private credit fund goes bust, that's really bad. If a hedge fund goes bust, that's really bad. But it's far worse when a bank gets toxified, because of their role in the payment system, and economy and society is so dependent on that. And that was the horror that was in front of the policymakers in 2008, and why I think they rightly did the bailing out that they did at that time.
So another point I wanted to touch on in terms of the interaction between regulation and growth is we've seen a lot of sharp swings recently in terms of policy statements. So like in the US, you can have policy changes over Truth Social or wherever he tweets about the credit card changes. And there is, I mean, the pendulum's always swung back and forward, but in terms of the rhetoric, it seems to have gone way up there. So how important is it to have consistency in terms of regulation? Because when I talk to some people in the US, they do not see where we're at now as being the steady state. And they're already planning for when some of this gets built back up post-Trump. So how important is it not to have wild swings?
I mean, you've almost answered your own question. I think it's super important. And the uncertainty that goes with all this is itself terrible for investment and growth. So the uncertainty itself and the flip-flops and the extreme statements. And although what's going on in the US is the most vivid, I mean, we have had some episodes here, going back to my competition policy world, where a year ago, the government ousted the chair of the CMA, who is a very experienced business person, thoroughly good, nice, sensible individual, ousted. And if you know anything about the CMA, you know that the chair doesn't have anything much to do with the cases. So it wasn't really connected to anything. But the Chancellor recently was, according to reports, was holding this out as a very important step that the government had taken. That rather shook me. So these things can happen. Also, there was the, I think, infamous boot on the neck. Was that the phrase? Regulation.
Oh yeah,
regulations.
yeah.
And that wasn't in a sort of Q&A.
Rachel Reeves speech about regulators.
That's in the Mansion House speech.
Yeah.
So that's a very considered
Like
remark.
gets vetted by about 10 people more.
You would hope. You know, if it was a Q&A, people
right,
say,
okay.
really surprising thing to say, particularly from that quarter. You know, very odd.
We have time for 1 or 2 more questions if we have them, and then I think we're just coming past the hour.
Maybe it's like lending. No more requests.
Have we stated? Okay, we've got one more question from gentleman here.
I mean, I've already gone before, but it seems to me that there's, I guess, the elephant in the room is the kind of regulatory arbitrage question, particularly, you know, is the argument for reducing bank capital requirements that at the moment the risk of shifting into shadow banking? And that's the argument you often hear from people who are critical of Basel, is that it just increased the cost of bank intermediation. So then we get other forms of intermediation which are less well supervised. And my personal interest in the pre-positioning idea is that it helps to stem some of that rehypothecation and securitization risk that fuels shadow banking.
Well, I mean, first of all, I think it's quite doubtful that there's a large effect on intermediation spreads, because I think the cost of more equity, provided you phase it in over time, if you're going upwards, for Modigliani, Miller, and other reasons, I'm not sure that there is a huge effect. Also, people have made this point about migration to shadow banking again and again and again. We haven't, in this country at any rate, seen a vast amount of it. Also, it might be, it's rather clever sort of phraseology, just like junk bonds was very clever because it's made them sound terrible, but actually they were very lucrative. It was shadow banking. It might be perfectly efficient to disintermediate a lot of forms of financing. So it's not necessarily a bad thing, but I don't see a big, particularly in domestic banking, a big arbitrage play in operation here. So I wouldn't be too worried about that.
So we did try calling them NBFI for a while. Does not do as well in headlines at all of shadow banking, I must say. So we're back to shadow banks. Okay, I think that's it, unless you've got any final questions. So thank you so much to our guest, John, for his many contributions. Thanks for all your questions.